Nilesh Shah is with us now of Envision Capital. Nilesh, great to have you with us here. Thank you very much for your time. Appreciate it. So the question, Nilesh, is what to do now, right? I mean, where to focus your energies on in trying to find opportunities. And before you answer that, if you can give us a sense whether an easing cycle will provide more impetus for even top performers like the Indian stock market. Go on, Nilesh.
I think the markets will continue to favor strength. And from a global perspective, clearly India has been the strongest bastion and has been the strongest kind of island, if you may call that, from a global investment landscape. And with this environment of aggressive rate cuts, that should only augur well for a market like India and an economy like India. The reality is that global international investors, foreign investors have been underweight India. India's weight in various market indices has been kind of galloping ahead, and they have not yet been able to catch up with that. So clearly, I think an environment of rate cuts, cost of capital coming down, I think that should essentially trigger them to kind of allocate more to India. So I clearly believe that while global growth could be a concern, specifically growth in the US, and that's what I think the US Fed has highlighted in terms of jobs. So that will be a headwind, but clearly for India, this headwind could actually end up being a very, very strong tailwind. So that plus the strong domestic liquidity are something which will continue to favor Indian market. So to that extent, I think while conventionally a rate cut cycle has not necessarily resulted in a good equity market, but probably this time around, India is probably going to kind of keep behaving differently the way it has over the last couple of years. So to that extent, I think this bodes and augurs well for India.
So what sectors do well, Nilesh, and where will you look for opportunities? Will you look at something which you were not looking so far? Let's put it that way. We know some color on what you own and what you like from our previous discussions. But would you look at something which you were not looking at so far and now you'd want to because of what has happened?
I don't think the investment strategy or the style is going to change materially with this development, Prashant. I clearly believe that the two most powerful themes from an India point of view, which are very long-term structural in nature, are around urbanization and digitization. These two are essentially the most powerful structural multi-year kind of trends. And these continue to be favorites. I clearly believe that digitization still, I think, is being undermined. I think most investors are kind of having a chorus around valuations, but clearly believe that growth and the upside from a business point of view is far going to outweigh the near-term valuations. And I clearly believe that investors are still significantly underweight on digitization-oriented opportunities, online businesses, consumer, fintech, and they will continue to positively surprise for several years. Yes, sure, there will be one or two intermittent quarters where they could have some kind of a patchy performance, but otherwise I clearly believe that remains the most powerful thing. Similarly, consumer discretionary, I think that's again going to continue to do well. Prashant, also the last 2 or 3 years, a very large part of the government's allocation has gone towards infrastructure. That continues to be north of 3% of the GDP. But in addition to that, what we have seen in recent months is essentially a lot of cash transfers which are going to happen at the state government levels. And these are humongous amounts. I mean, individual states allocating 20, 30, 40,000 crores as cash transfers. That essentially is going to rev up the entire consumption space as well. And several discretionary products are going to essentially enjoy strong tailwind. So I clearly believe that while we so far over the last 2 or 3 years have been seeing one side of the market perform, which is the capex infrastructure-oriented place, but I think going forward with falling commodity prices, falling input prices, falling interest rates, and these cash transfers are going to provide massive tailwinds for the consumer-oriented businesses.
All right, Nilesh, you speak about digitization. And can't talk enough about how big that opportunity is. We have Info Edge, which is doing extremely well. Brokerages are positive on that. Zomato, we've seen a massive run that has happened. And this morning, there were a couple of notes coming in on FirstCry as well. But we can't, have you and not talk about the IT pack? Because yesterday it was under a lot of pressure. Now it's seeing a bit of a bounce back. From the lows, generally, the IT index has seen a rally of nearly 30% as well. How do you look at the US economy and Indian IT stocks in conjunction to that?
So Mangalam, I think the entire US economy, I think, is going to go through headwinds for some time. And that honestly doesn't augur well for the big conventional IT services companies. So I clearly believe that that's really not the space to be in. But there are several tier 2, tier 3 IT services companies which are having niche offerings around products, around services. Some of them have built strong AI capabilities. And they will be able to grow at a substantially higher pace versus their the bigger ones in the peer group. So I probably think that this rally should be probably utilized to continuously switch from the large cap IT names, the top 3, 4, 5 names, and move over to specialized tier 2, tier 3, mid cap, small cap IT services and IT product companies. And that probably is the space to continue to be in.
Okay, mid-cap IT companies and fintech, consumer tech, the other aspects of technology beyond traditional IT services. Got that, Nilesh. Good listening into you. So, beyond this, I think the other question that people are grappling with is whether the leadership change away from CapEx, from manufacturing, from that entire side of the market, PSUs, whether that indeed is now well entrenched, if it's truly underway. What would you say if someone's still holding on to those positions? Is it time to book profits? Should you stay away, or should you look at buying the dip? I mean, where do we stand on that entire, massive move that we saw for the last 2 years?
That space surely deserves a much lower weight or a lower allocation. I think if somebody's kind of been there 3 years ago, 2 years ago, or maybe even a year ago, it might actually be a good time to kind of take some money off the table. Especially in the conventional defense names or some of these other infra-oriented spaces. And clearly, I think, move towards more of the consumer, the online, the financials. I mean, banks have been a big pocket of underperformance. That might be a good space. NBFCs, HFCs, these are the kind of places where incremental capital allocation ought to be done. In addition to that, even within the overall CapEx infra space, maybe the ones which are more veered towards the manufacturing side, the semiconductor side, these are probably the kind of areas where one should kind of veer more towards rather than the conventional CapEx names. So clearly, I think this is an environment which really will call for some tweaks in portfolio strategy. It will call for some kind of reallocation in terms of sectors. So clearly, I think it's time to kind of be a slightly cautious on the CapEx cycle, on the defense cycle, not because these businesses may not do as well. These businesses will do well, but just that the valuations have gone up so much that they factor in much, much higher growth, which I think may not be possible. They'd probably still grow at 10, 15, 20%, but they essentially will not grow at the kind of pace at which they have been growing over the last 3 years.
What else are you cautious on? Nilesh, what else are you cautious on?
I think that I kind of earlier talked about the large cap IT. I think that space calls for caution. Clearly, again, for commodities, this is a difficult time for commodities. It will be a difficult time, especially if global growth slows down. Demand, I think, is going to be challenging. There could continue to be more softness in terms of commodity prices. So I think one should be very careful even with the typical commodity and the cyclical space. Obviously, users, consumers of commodities will do very well, as they essentially will have lower input prices, which could obviously bolster their margins. So clearly, I think avoid producers of commodities and basically kind of be more towards the consumers of commodities.
Nilesh, finally, to wrap things up, I mean, back to a market question, really. And I was just thinking that the last time we got into a US rate cut cycle, I mean, the big ones, let's go back to 2008-9. It was basically in response to a massive crisis, right? Markets had collapsed, and then the rate cuts kicked in, and then 2009-10 onwards, we started getting the market rally. Ditto for COVID. The market fell, there was fear, then the US Fed started cutting rates, and then the market rallied. This time the difference is that we've gone into the rate cut cycle on a song, on a dance, right? Markets are at all-time highs, whether it's the Dow, whether it's India, NASDAQ, whatever you look at. So in that sense, can the party just keep continuing? Or do you think that there's some risk out there that we've perhaps missed?
The party, I believe, will continue. At least I can say that the India party looks pretty good. We surely have higher growth, we have moderate inflation, and we have stronger liquidity back home. So I think the India party will continue. Just that when these global headwinds, which have started to kind of surface, or you could probably say resurface, there would be breaks in between to this party, and that break could probably be shorter, but could kind of be steep as well. So I wouldn't rule out at any point of time maybe a 5 to 10% correction in the market indices and maybe more correction in individual stock prices. That I think is quite possible, and that's like par for the course, especially if you're essentially looking at a slightly more medium to long-term perspective. So clearly, I think yes, and historically, every year we do have situations where markets during the year correct 10 to 15%. So that possibility can never be ruled out. But clearly don't believe that the India party is over. The India party is essentially still kind of has way more to go before we can say that, we're done with the bull market.
All right, Nilesh, thank you so much for joining in. Always a pleasure speaking with you. India party is likely to continue, far from over. On that optimistic note, we'll take your leave with the news that the market still continues to hold on to its initial gains. The Nifty